introduction about our company. First of all, thank you for your time joining us tonight. My name is William, and I am a marketing and dealer of Phillip Futures Sdn Bhd. Okay, and just a very quick introduction about our company here. And before we start, just a very quick disclaimer also. Whatever that we share tonight is mainly for knowledge sharing purpose, and it doesn't really constitute any buy or sell advice. So our company, Phillip Futures, we are a subsidiary of Phillip Capital Holding, and our mother company is actually in Singapore, okay, based in Singapore. That is our mother company, and our headquarters is based in Kuala Lumpur. Phillip Futures is incorporated in October 1995. Okay, so we have been in business, in the futures business, in the securities business for quite some time now. Our company, we are a trading and clearing participant of Bursa Malaysia Derivative Berhad. With this, we are a CMSL license, meaning to say we are legal to operate as a broker house in Malaysia and regulated by the Security Commission. So our company is the first company in Malaysia to actually offer an online trading platform for both local and foreign products, meaning to say you do not need to log into different or multiple accounts to trade both local and foreign products. Everything can be done under one roof. So yeah, it's super convenient, which is also the reason why we are the top choice among the professional traders in Malaysia. So with this, I would also like to take this opportunity to say a very big thank you. If you are our clients, okay, without you, we won't be able to achieve this. In 2019, Bursa Malaysia, they actually award us 3 big awards, okay, being the first one as we are the best institutional derivative trading participants. So like I said, we are among our company is the top choice among lots of local traders, okay, locals meaning they are professional traders, yeah. So our company, mother company, Phillip Capital, we don't only operate in Singapore and Malaysia, we have offices in over 14 different countries. With that, we don't only offer products in Malaysia or Singapore also, we offer products from all over the world, including Hong Kong, US, Japan, etc., etc. So just like our company name, Phillip Futures, we are specialized in futures trading. But recently, lately, last year, we actually introduced a new product called the Contract for Difference, which is also the main product that we are going to teach you how to trade in the webinars tonight. So this is a very quick one on why you can trade and why should you trade this US share CFD with our company, Phillip Futures. First of all, we allow our clients to do short selling on US stocks, first of all. Second, we offer very competitive brokerage on US CFD. In fact, our margin CFD account on US stocks is even cheaper than lots of cash account that allows you to trade US stocks in other broker house. You can find us in the comment box or private messages on our Facebook or website to find out about the brokerage, and we are even giving out a promotion for 3 months. So third, we allow our clients to trade with a very low capital requirement, and the fourth one will be we offer 24-hour support. US market is usually open during the night time, so if you have any problems, you want to call in to place your order, you are more than welcome to do so. We have a 24-hour support desk. Lastly, all the corporate actions such as bonus issue, dividend entitlement, you are all entitled for it. So this is the benefits of our Phillip Futures Share CFD. So why trade with our company? So first of all, it's like I said, we offer 24-hour support. Second, we offer latest market news on both futures and also on the stocks, okay, exclusively for our clients only. Third, we offer advisory advice. So if you are interested in trading but you do not know where to start, feel free to approach us. We can help you. We are more than happy to help you out. Okay. Lastly, we offer products not just in Malaysia but from all over the world. Now, learn with us. We offer free one-to-one coaching session. If you want to find out more about this, let us know. If you have totally no idea what is futures, what is CFD, don't worry, talk to us. We are more than happy to organize this one-to-one coaching session with you. Second, we offer seminars that are free or webinars that are free for a monthly basis. And third, We offer free online account opening also. Online account opening is free of charge. We don't charge you anything, but you need to fund in to activate your account. And we are the first company in Malaysia to actually offer an online account opening on futures. Okay, so if you want to open a futures account, you can do so through the internet. You doesn't need to come to our office, and it is MCO right now. You can do it at the comfort of your own house. Okay, now let's start our seminars, webinars tonight, and I will pass it to our speakers of the night, Mr. Bong Jeen Hao. He has been in trading the stocks market for many years, and he even conducted classes, etc., for quite some time, and his students has been trading really well with great results. Okay, let's hear from him.
Hello, everyone. Welcome to the session. Okay, let me just figure out what should I do now. Okay, all right. So welcome everyone. If you can see the slide right now, type a yes in the comments box. Okay, all right, good. Thank you very much. Okay, so I know that you can see me. Okay, so first of all, I would like to thank you all for participating, attending this webinar. And I highly respect you guys for two reasons. First reason being the webinar right now is 7. I understand that this time, maybe some of you are actually having dinner, okay? So the second thing is, whenever we talk about money management, risk management, this is what a lot of people actually choose to avoid. A lot of people, when they come to trading and things of that nature, all they want to know is just the strategy, how to make money from this, or why you make money from this stock, why you make money from that stock. That's the thing that people are interested in and they are obsessed with most of the time, but they don't know that a lot of time what kills them is actually the poor risk management as well as the mentality. So if you have missed the previous round whereby I talked about strategy, I think you can maybe talk to Philip. I think they have some recordings. Okay. In this webinar, I only talk about risk. Okay. I only talk about one thing, risk. And not only I talk about risk, but I share with you about how do we manage risk from the professional angle, meaning that as a professional traders, how do we actually manage our portfolio even if we are leveraging? I think this is very important. A lot of people die in the market is because two reasons. Because the first time I joined, quote unquote join, okay, the share market, a lot of people will tell me, okay, especially like my relatives, like, oh, don't join, don't trade, okay, stock market is very dangerous, things like that, 1997 now, which big bosses, they blah 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 blah, and then they lose a lot of money until they steal all the bank. Then I was thinking, how can you lose money until you owe the banks? So I was like, it cannot be leh. If I buy a share at $10 and if the share drop to absolutely zero value, zero in price, the most is I lose all my money plus the brokerage fee. How can somebody end up still owing the bank money? So after that, I realized there's two reasons. First is they don't have stop loss, meaning that the share is dropping and dropping and dropping. They keep finding reasons and excuses to support to support their decision of not selling off the share. We see a lot of people right now in the market. Okay, there is one sector dropped for quite some time already, but every day still find news to support because they are stuck in the stock. Okay, and what else? Second thing, if you don't leverage, how can you end up owing people money, other people's money, other parties' money? Okay, so to couple with poor risk management, as in no stop loss plus leverage, that's the perfect recipe to fail in the share market, put it in this way. Let me be very direct with you. So first of all, we have 70 over people in this webinar. I want to congratulate you for making the right decision to actually attend this webinar. because this is the single most important thing when it comes to trading. And also, I'd like to take this opportunity to thank Philip, okay, for having me here tonight, and share with you guys these very important uh, lessons. All right, so let's go to tonight's topic. CFD, leverage your portfolio with proper risk management. My name is Jeen Hao. Okay, so I'll be talking to you guys for this session. All right, so let's begin. Okay, so again, disclaimer as usual, whatever share I talk about later is just for purely educational purpose and case study only. There's no buy or sell call in this webinar. All right, so this is me personally. I'm a position trader in the capital market, focused on stocks, including CFDs and futures. I'm the founder and also chief master trainer of Street Finance. So I have a signature program that I actually coach individuals how they can consistently profit from the stock market without monitoring and speculating. You're not going to deal with things like, if the share dropped 2 cents, how? Late this morning, market gap up and suddenly goes down, then back up again. Why this happen? How do we measure? You are not going to deal with all these kind of speculations. Okay, and I've been featured in medias and things. I spoke for Bursa and other investment banks as well. Okay, and I frequently uh, spoke, okay, for universities and college. In fact, last night I just did once. Okay, so content outline for this webinar. First thing, understand the concept of R multiples. We are going to see risk at a very professional levels. Okay, so things might be very intense a little bit for those who, okay, are listening these risk kind of things, okay, for the first time. But this is how professionals manage risk, and it can be a little bit uh, complicated, but just stick with me. And also one thing, if you want to get better ideas and learn better throughout these sessions, okay, I'll just give you maybe 30 seconds to take pen and papers. Make sure you have pen and paper next to you, and also a calculator. Okay, and also a calculator. So if you are using your phone to watch this webinar, get a calculator or get another phone. If not, you can just take out your phones and launch the calculator app. Okay, ideally you have pen and paper with you as well. Okay, so second, how professional manage portfolios. Okay, this is also very important. Third, when to leverage and when not to leverage. And last but not least, the key to scale up your portfolio return. Okay, so these things are what are the things that I'll be covering tonight. All right, let's move on. Okay, first thing, understand risk reward ratio, R and R multiples. These are the terms that professional traders use. Okay, so many investors and traders get excited when they talk about profits like 150% gain, 10,000, okay, $100,000 in profit and things of that nature. However, from a professional standpoint, how much you risk to make that profit is far more important, is way more important than how much you make. You might be making 20% gain, which is good, but we also have to know another piece of the puzzle, which is how many percent, or how much money you are risking to make this 20% gain. This is the missing puzzle that a lot of people's trading habits and journey. Okay, this is very important. So how much you risk to make the profit is far more important. Okay, now second, the initial risk. Okay, we're talking about the initial risk is often quoted in R. What is the initial risk? Initial risk is the distance between your first entry price and your stop loss. And apart from that, okay, this is also a percentage of your account size that you lose if the trade goes against you. For example, 1%. Okay, so initial risk is very important. This is your entry, the distance between your entry and your stop loss. Okay, this is always known as R. initial risk. Okay, so for example, if you long a stock at $500 with a stop loss of $450, your 1R, which is 1 unit of risk, is actually $50. Okay, so unfortunately, the stock goes down and hit your stop loss at $450. In this case, you lose 1R. Okay, so this is how we see risk. Now, profits and losses can be expressed in a multiple of the initial risk, which is known as R. Okay, and this is known as R multiple. Okay, you want your losses to be 1R or less, depends on the situations, and your profits to be as big as possible. So let me give you an example. You long a stock at $500 with a stop loss of 450. So your 1R, again, this is the same scenario as the previous example. Your 1R is $50. The stock goes up in this case and you take profit at $850. So in this case, you win 7R because how much profit you have? 850 minus 500, you have $350 of profit. So $350 of profit, how much do you risk to make this profit? You risk $50. Okay, you risk $50 to make this $350 of profit. So you win 7R. This is what we call R multiples. So a lot of times when we talk with professional traders, we don't really tell, hey, how much you make last year? Oh, 450,000. No, we don't speak this way. We don't speak this way. It's either we use percentage or we use R multiples. Okay, so understand that risk reward ratio, your initial risk, which is R, and R multiples, okay, which is how many times you make, okay, how many times you make, okay, or as opposed to what you risk. Okay, so this is an example. So in this case, okay, let me just pop up the laser. In this case, you enter this stock, okay, at this price 503, for example, and because this is a highly volatile stock, this is Tesla. This is a highly volatile stock. So because you enter at a breakout, you still want a very good stop loss point, a very reasonable stop loss point. So you set it at below the swing low, okay, here below the swing low, which in fact you risk 24.5% for this trade. And yes, true enough, the stock went from $503 to $800 and you make 60.9%, 60% of profits, which is good. Don't get me wrong, which is good. However, how much do you risk to make this 60%? You risk about 24%. So in this case, your risk to reward ratio is 2.5, 2.49 to be exact, if you can see here. Okay, so your risk reward ratio is 2.49. Okay, is that good? Yes or no? Yes and no, the answer. Because you are risking a lot to make that 60%. In contrast, this is another trade that I took. Okay, I entered Starbucks, okay, at 95.60, and because the stop loss is tighter, the stop loss is only around like 4%, okay, less than 4%. So I only risk about 4% to make 10%. So you see, a stock go up from $95 to $105 in this case is nothing worth bragging. Okay, if you tell people, well, I buy a stock at 95, the stock go up to 105, a lot of non-professionals, okay, will even laugh at you. However, from a professional standpoint, this is a good trade because your risk reward ratio is 2.67 in this case, which is better than the previous stock, in this case Tesla. Okay, so yes, Tesla did make a good move, but you are risking a lot to make that profit as well. Okay, now these two trades are great. I'm just here to share with you that not all the time, okay, because a lot of time people think about risk only. Wow, you make 10% from Starbucks and you make 60% from Tesla, the Tesla must be a very good trade. In fact, these two trades, from a professional standpoint, it is somewhat equal. It is somewhat equal. Later you will know why is this so. Okay, so the next thing, let's jump into how professional manage portfolios. Now, the first thing, professionals manage their money by treating it as a portfolio. If you have 1 million today, you use that 1 million, to buy glove stocks. You are not managing your portfolio. That one is more towards like betting that the glove will go up, you make big money. Okay, so for professionals, we manage money by treating them like portfolios. Okay, so once you have an entry and stop loss, meaning that once your entry and stop loss is already determined, you get your initial risk, which is R. So for example, you enter at 10, stop loss at 9, then your initial risk is 1, your 1R is $1 or 10%. Okay, you get your initial risk right over there. The next thing, is to predetermine how much you want to risk for your portfolio each time you make a trade. This is known as risk per trade. Okay, for example, 1%. I always encourage people to start with 1%. You might think that this is way too boring, but let me just ask you one question. Are you in the market for excitement? Or you want to make consistent money from the market? This is something that you need to answer. Okay, so the risk per trade should be constant across all trades. You cannot be like, I like Nvidia better than AMD, so I'm risking 3% for Nvidia and 1% for AMD. No, you cannot do that. Okay, the risk has to be standard across everything. You cannot have any kind of bias. Okay, so for example, 100,000 portfolio and a 1% risk per trade means every time when you lose 1R, meaning that one stock hit your stop loss, you will lose $1,000. And when you have 2R win, your portfolio will grow by $2,000. This is how we grow portfolio, with a limited risk that is already predetermined. Okay, so calculate your position sizing. That's the next step. In layman term, what's position sizing? It means how much to buy. Okay, how much to buy. So this is the position sizing formula. You might want to write it down. Okay, so position size equals to your net liquidation. What is net liquidation? Net liquidation is your total value of the stocks that you have multiplied by the predetermined risk per trade. Okay, divide by your entry minus stop loss. You might want to write this down. Okay, so this is how we calculate position size. All right, so let's give you a couple of examples. Okay, so for example, your net liquidation is 100,000 for easier calculation. Your risk per trade is predetermined at 1%. Let's say you enter a stock at $500. You have a stop loss at 450, which is 10% based on the stock. Okay, and your position size, how do you calculate? Basically, you take your net liquidation, which is 100,000, multiply by 1%, divide by 500 minus 450, your entry minus stop loss, and you get the answer 20 units. So what does this mean? It means that you are going to buy 20 units of this stock at $500. You buy 20 units of this stock. Okay, you buy 20 units of this stock. Now, what does this mean? This basically means, guys, this basically means today you buy, $500 times 20 shares, meaning that you are using 10,000, dollar to take this position, this stock, whatever this stock is. If the stock hit the stop loss of 450, you sell your share at 450, okay, and because you have 20 shares, it means that you will take back 9,000 after hitting the stop loss. Okay, so meaning that if you were to hit stop loss, you lose $1,000, which is 1% of your total net liquidation. This is how, okay, we manage portfolios, meaning that you can hit more than 100 times of stop loss, you will still not end up owing people's money, because your net liquidation will get smaller, smaller, and smaller. So the net liquidation, the number will change. Okay, so that is the thing. All right, so let's give you another example. Okay, same net liquidation for easier calculation, 100,000. Your risk per trade 1%. Your entry this time around is a little bit tricky. Okay, 98.1. Okay, your stop loss is 92.85. So what is your position size? Okay, can anyone with calculator please calculate and type it in the comments below? Okay, what is the position size for this trade? Okay, no one. All right. Okay, some people type 19, 190. Okay, let's move on. Position size, same, 100,000 times 1%, divide by 98.1 minus 92.85, you basically get 190.48. But because you cannot take fractional shares, in US, you can take 190 units. That is how we round down, we don't round up. Okay, we always, it is better be at the safer side. Okay, so this is how we basically, this is how we manage the risk. Okay, this is basically how we manage the risk. So this basically means every time when you take positions, okay, how many positions you want to take, you already know how much your portfolio is exposed to. Okay, how much risk your portfolio is exposed to. Okay, now this is what I want to tell you. Knowing how much risk your portfolio is exposed. For example, back to you using back the same amount, 100,000 portfolio, your risk per trade is 1%. Okay. So first one, you buy into stock A, entry 53, stop loss 48.65, for example. So you end up buying 229 units and you are going to use up $12,173. Okay. And you buy into stock B, your entry is 919, stop loss 848. So you will end up buying only 14 units because this stock is slightly higher priced, but you still use about $12,000 to enter this trade. Next is stock C, your entry is 65.8, stop loss 59.9. So you end up buying 169 units using 11,000. Now, the tighter the stop loss, okay, the tighter the stop loss, the larger the position size will be, meaning that you will use up more money to buy that particular counter. Okay, so this is, okay, this is how we know how much we are risking. So let me ask you one thing. Let's say this is the exact situation. How many percent risk this portfolio is exposed to? Type in the chat box. How many percent risk this portfolio is exposed to? Okay. Okay, I think I start seeing 3. Okay, very good. Okay, very good. So this is, okay, this is exactly how we treat our portfolio. So meaning that it's only 3%. Why is it 3%? If stock A were to hit stop loss, my portfolio will be down by 1%. If stock B were to hit stop loss, my portfolio will be down by 1%. If stock C were to hit stop loss, my portfolio will be down by 1%. Okay, so this portfolio only exposed to 3% risk if things happen smoothly, meaning that there's no special case like the stock gap below your stop loss. So you are going to risk slightly more than your predetermined risk, which sometimes happen, but it is not an everyday thing. Okay, but again, this gave us a level of securities and understanding about the risk that we're exposed to. So if you want to take third trade, fourth trade, fifth trade, sixth trade, you want to buy 6 counters for your portfolio, and you know that your portfolio is only exposed to 6% of risk. So it is up to you whether or not you want to take this kind of risk. If you think that if everything goes wrong, suddenly political news, whatever thing go down, my portfolio lose 6% and I'm okay with it. So if you're okay with it, that's an agreement you sign between you and the market. If anything happen, my portfolio is exposed to 6% risk, I'm okay with it. So you go out and find some other shares that has the opportunity. Maybe the setup is good, you can trade a breakout, you can trade a rebound, anything. Okay, so this is what portfolio management is all about. Okay, and again, we trade based on risk, not hype. Okay, first stock being JD, second being Tesla, and Tesla is a stock that has a lot of stories going on and it's very hot. This stock is very hot. Okay, and the third one is mRNA, which is also another stock that has been very hot, was hot last year. Okay, now there are still people who are trading it. Okay, so for example, I will exit, okay, JD at $74.56. I win 4.96 R. Okay, I win 4.96 R. Let me ask you one question. How many percent my portfolio is right now? My portfolio right now, this exact portfolio right now is going up by how many percent? Okay, contributed by this trade, JD, win 4.96 R. My portfolio or this portfolio is up by how many percent? Please comment down below. Guys, you have to listen very attentively and participate along, and that's how you understand, okay, this situation. Okay, it's about 5%, okay, but it's 4.96% to be exact, minus your commission. It's around 5%. Okay, so this is how we grow our portfolio. Okay, this is how we grow our portfolio, and this is the basic. If you are thinking about taking your trading to the next level with leverage, if you don't know all this, okay, it is very dangerous. Okay, it is very dangerous. So this is how we grow our portfolio. We risk 1% of our portfolio, and then this trade went well, and it made 4.96% for our entire portfolio. And this is the exact trade that you can see. Okay, you buy based on the rebound with a risk, and then when it went up and hit our trailing stop right over here, and that's how we exit the share. Okay, the share went up by 40.68%. It doesn't matter, but in a risk reward standpoint, it is 1 to 4.96. Okay, it is 1 to 4.96. All right, so let's move on to the next one. Next one, Tesla. So I exit, let's say, at $1,479, $1,479. So the win in this case is 7.89 R. This is pre-split for Tesla. Okay, so again, as a result of this trade, the portfolio is up by 7.89%. And this is exactly, okay, this is exactly where you can plot an entry and where you will be whacked out, okay, from the portfolio. Okay, so this is Tesla. Okay, now let's say the third trade is losing and I'm exiting at 59.90, exactly at 59.90, so I lose 1R. So meaning that from JD, my portfolio is up by 4.96%. From Tesla, my portfolio is up by 7.89%, which is great. Okay, which is very fantastic. Your portfolio is up by like 13%. Okay, is it 13% roughly? And as a result of this mRNA, the third trade, okay, your portfolio is down by only 1%. This is what we call risk reward ratio and things like and risk as a whole. Okay, if somebody were to come and tell you that I make a lot of money from glove during Q2 of 2020, and because I make some mistake, okay, and the previous gain, which is maybe 100%, 200%, the previous gain is all wiped off. If somebody were to tell you this, you know that this person confirm no risk management. Because guys, I want you guys to see one thing. From a professional angle, you see this portfolio is up by 4.9% plus 7.8% minus 1%. Meaning that if this is the current situation of my portfolio right now, the gain is still very substantial. Okay, it's about 11 to 12%. Meaning that, guys, if you want this portfolio to go back to square one, I need to hit 10 to 11 stop loss before my gain is being wiped out. Okay, before my gain is being wiped out. So this is what I want you guys to understand. A lot of people say, hey, Jin, how you make money? Who and who make money? You hang lah. You bought Tesla, you hang lah. Okay, you make money from glove. First round you hang. You second wave you didn't lose a lot of money, you hang. Now this is not about lucky or not lucky. This is about skills. Okay, this is about skills. If you have few big wins, by right, that portfolio should be able to withstand a series of stop losses before you are going back to square one. Okay, so this is the power of portfolio management. Okay, so if you follow up until here, okay, please type yes in the comment. I want you guys, okay, I want to make sure that you guys understand this part, because when I talk about risk management, sometimes things can be very, very boring and dull. Okay, so this is the thing about portfolio management. Okay, so if you follow me on Facebook, okay, you will see a lot of example whereby my student, okay, it is not about luck, by the way. Okay, I don't really have good lucks. Okay, sometimes I hit like 2-3 stop loss one go, but because I have one big win and two big wins, okay, I can withstand, I can tank, I can endure a lot of stop losses, okay, before it actually hurts my portfolio. Okay, so if your portfolio management, your risk management is spot on, if you are very unlucky, nothing disastrous and devastating should be happening. Okay, so I hope that this piece of information alone worth your time tonight. Okay, this is what I teach, okay, to my graduates, to my student in my program. Okay, so tonight you get it, okay, right over here. All right, so this is mRNA. So you can see sometimes even if you are trading 1% risk, okay, and you hit a stop loss. So being this is actually an uptrending stock, but because, okay, you might be plotting your entry at the very last wave, for example. This is something that we cannot tell whether or not the uptrend will continue, but probability wise, uptrending stocks will keep going up. Okay, so you can see that you plot an entry here, it rebounds a little bit. If you did not have the habit, if you don't have the habit of taking profit, it will end up to a stop loss. Okay, it will end up to a stop loss and you lose 1R. Okay, and you lose 1R. Okay, so I see a question, risk 1%, how about reward? How to set? Now, you can refer back to my previous webinar in this series, whereby I share about how to write big trends. Okay, how to write big trends. Basically, we have a technique called trailing stop. Okay, so we let the stock to go how high it can go. So we let it runs. Okay, before it bends to a downtrend, it stops us out. Then we take whatever profit we have. This is what I call trailing stop. Okay, we don't go and guess how far, okay, a stock can go. Okay, we don't go and guess how far a stock can go. And this is the key, basically, of how do you actually write a big trend coupled with great money management. Okay, so why most people lose money leveraging? Okay, leveraging is a double-edged sword. Okay, leveraging is a double-edged sword. So if you use it right, it is very powerful. If you use it wrongly, in a not so appropriate way, definitely you're going to get hurt. Okay, so first thing, why most people lose money leveraging? First thing, poor risk management in their trades, be it emotion, ego, poor analysis, or poor analysis that they thought are good, okay, etc., etc. So poor risk management on your trade. Okay, they are egoistic, they have bias with the stocks that they are holding, and that's the reason why, okay, people get hurt. Okay, and coupled with leverage, that's a disaster. Second, they have no idea about portfolio management. Okay, they'll just think like, oh, if I got 20,000, I'll just use up my 20,000 to buy 1 or 2 shares. Buy one share is not good because people teach me about diversification. So I use 20,000 to buy 2 stocks. Okay, that is, yes, some sort of diversification, which a lot of people may have already know. Okay, but most people don't have any idea of portfolio management. Now, by the way, how many of you always have this question every time when you want to buy one stock, you don't know how much to buy? Okay, if you have this question, I believe you already got the answer. Okay, you always have the question, how much to buy? Hey, this stock looks like very good, looks like I want to go up. Okay, and things are looking great, but I don't know how much to buy. If you always have this worry, this question, this issue, type in the comments position sizing, because this is the answer that I have already shared with you just now. Okay, all right. Now, third, they have no idea. Okay, they have no idea about their odds in the market, which is their own risk reward ratio and a winning rate. Meaning that after trading for quite some time, you should know a few things. What is your average risk to reward ratio? Meaning that every time you win, how many R you win? Is it 2R? Is it 3R? Okay, your risk reward ratio. You always risk one to make how many? Okay, because some people, they have a very weird risk reward ratio. Okay, there's a very weird risk reward ratio, just like one of my relatives. Okay, if she bought a stock, she can buy, okay, like maybe at a price, and then if the stock dropped 20%, 30%, okay, she can just keep holding. Okay, she can hold on a very huge loss. Whether or not the stock one day come back is another thing. But every time when the stock go up, she sells at 5%. And then he said, Jeen Hao, I tell you, we cannot be very greedy. FD 1 year only 3%. This stock 1 month run 5%. We humans should not be greedy. Okay, so don't be too greedy, sell. Hey, what kind of risk reward ratio is this? Risk 30% to make 5%. For me, this is ridiculous. You might as well put your money in fixed D. Okay, so the next thing is winning rate. Okay, is winning rate. Out of maybe 10 stocks, 20 stocks, how many stocks end up in a profit and how many stocks end up at a loss? Okay, so let me give you an example. Okay, let me give you an example. if you always risk 1 to make 1. Okay, if this one is a risk reward ratio, this one is a risk reward ratio. Okay, next we talk about winning rate. Okay, to break even. Winning rate to break even. If your risk reward ratio is 1 to 1, you need a 50% win rate to break even. Okay, 50% win rate to break even, meaning that every time you risk 10% to make another 10%, okay, with this kind of risk reward ratio, okay, you need to be 50% right all the time in order just to break even. So meaning that you want to be profitable with these metrics, you need to have a higher win rate or a higher risk to reward ratio. Okay, so if your risk to reward, you always risk 1 to make 2, okay, your risk reward ratio can be is 1 to 2, for example, then your winning rate for you to break even is way less than 50%. Okay, it's less than 50%. So how much? It's about 33%. Okay, it's about 33.3%. Okay, 33.3%. If for some reason some people like to take a 20% risk to make 10% return, okay, for example, some people like penny stocks, 20 cents, they can risk 20%, like for example, their stop loss is 16 cents and the take profit at 22 cents. So meaning that these type of people, they risk 2 to make 1. Okay, and then with this, you need 67% of win rate to break even. So meaning that if you always risk a lot to make a little, you need to have high win rate in order to stay profitable. Okay, so in our previous webinar, okay, I have shared about how can you ride a big trend, okay, so that your risk reward ratio, because when you ride a big trend, your risk reward ratio on average over the long run will be very good. Maybe you risk 1 to make 4, risk 1 to make 5. So you don't need a very high win rate to stay profitable. So a lot of people say, if I only win 50% of the time, I'm not making money. No, you are wrong. Okay, because risk reward ratio is another piece of the puzzle. Okay, so because some people might think, hey, if I buy 10 stocks, 5 stocks make money, 5 doesn't make money, then I'm not making money. You are wrong. Okay, some people might think that. Why you are wrong? Because, okay, why this is not good? Why this is not the right way of thinking is because you have another piece of puzzle called risk reward ratio. So if your risk reward ratio is very fantastic, sometimes, okay, you can have a win rate of maybe 20% or 30%, you can still be very profitable. Okay, so this is the thing that a lot of people don't really talk about. Okay, now why most people lose money leveraging? Okay, hey, by the way, I want to add on, just because way too many people don't understand the odds in the market, and some more, they are greedy in a way that they keep leveraging without knowing the odds in the market. That's how they start losing a lot of money leveraging. Okay, so the next one is why most people lose money leveraging is gambling mindset. So they want to get rich quick by betting on certain stock to go up with leverage. They never consider the risk involved. Okay, it's like, wow, if this stock go up another 2 ringgit, okay, how much I can make? This is a gambling mindset. When people are gambling, okay, when people are gambling, they only think about the profit. Okay, so this is something that is killing a lot of people, put it this way. Okay, next, fail to execute stop loss, meaning that they maybe have a stop loss or they don't have a stop loss at all. And even if they have stop loss, they fail to execute it, especially trading a Malaysia market whereby we don't have a native stop loss order. Okay, this mistake is very deadly if you pair it with leverage. This is the exact reason why a lot of people can lose money and still owe other people's or banks. And so make sure you are not, okay, falling into these things. All right. So let me share with you the key to scaling up your portfolio return. Okay. So for example, this stock is doing well and you want to top up. Okay, because uptrending stock keeps going higher, probability wise and statistically proven. And one of our strategy is actually keep adding, okay, when a stock is going higher and higher, but of course with some kind of calculated risk. Okay, so for example, when it is going up, okay, higher and higher, you add some position at 65 and 10. Okay, $65.10. Because you bought at 53, so now you want to add at 65 and 10. So your new trailing stop, okay, trailing stop is when you move your stop loss upward, meaning that this is the new point that you're going to sell if the stock U-turn and go down, go against you. So this 58.45 is your trailing stop, meaning that if it were to turn down, okay, that is your new trailing stop. That's when you're going to sell and close your position. Okay, so one of the key to adding position is you want to make sure after you add position, if again, think about the risk. If the stock were to turn down, were to go against you and hit your trailing stop of 58.45 in this case, you will still end up with some profits. You don't want to make this trade become a loss because that's pointless. Okay, so based on this, okay, for example, in the first position, you buy 229 units at $53. You use up $12,137 to establish this position. And right now, you want to add on 180 units at $65.10. $65.10. So your new average cost right now is 58.33. So meaning that if it hits your trailing stop, it won't end up with a loss. Okay, but of course, this may not be the most perfect scenario. Okay, usually when I add, I don't add so much. Okay, because you can see 58.33 is very close already. So I might add like 150 units or even 100 units so that my new average cost, okay, is way lower, so that if it hits trailing stop, at least I still have like maybe 1 hour to 1.5 hour of gain. Okay, so that would be even better. But of course, the bare minimum is to make sure you don't turn a winning trade to a losing trade. That is the bare minimum. So for example, in this case, okay, you will have your new average cost of 58.33. Okay, so you spend another $11,718 to establish this new position. Okay, so in this case, you exit at 74.56 without adding position just now, you win 4.96 R. After adding position, you are winning 6.67 R. Okay, meaning that you make slightly more. Okay, you make slightly more return, which is, I think, a good thing. Okay, if it is done right. So let's say if it goes down and hit 58.45, okay, you will win 0.05 R, meaning that break even. Okay, in this case, it's break even because you still have the brokerage fees, things like that. Okay, so this is the key to scale up your portfolio return. Okay, you find another entry to add on position. Okay, so again, this is the scenario. Okay, you add position when it breaks out from this counter trend line, and you put a stop loss below the swing low and also the super trend support line right over there, right over here. Okay, and you exit somewhere around here. Okay, same exact scenario as just now. Okay, so now when to use leverage in this case? Okay, I want to answer this because most probably you might have already known that what do I in what situation you want to use leverage, or in what situation you can use leverage. Okay, how often can you add position? Of course, don't too often. Okay, every time when it goes up by at least 1.5 R to 2 R, you can think about adding position. That is the bare minimum. Okay, so at least knowing that, okay, adding position, okay, is the key to enlarge some of the results that you may already have. Okay, you may already have. So when to use leverage? Okay, now here is going to be a little bit mathematical. It seems like tonight's webinar, a lot of things are very mathematical. Okay, when you're risking 1% risk per trade, okay, for stocks with 10% stop loss, you will use 10% of your net liquidation to establish a position. Okay, so this one you can calculate yourself. You just put 100,000, for example, 100,000 portfolio, 1% risk per trade. If your stock has a 10% stop loss, meaning that the share is $50, for example, your stop loss is $45. This is what I call 10% risk for the stock. You will use up 10% of whatever money you have, your net liquidation. So in this scenario, you will use up 10,000 to establish that position. This is something that you need to know. Okay, when your stop loss getting tighter, you will use up more of your available capital to establish a position. Okay, so this is what I'm trying to share. Okay, let me just demonstrate to you. So let me demonstrate the first one. So for example, if you have 100,000 portfolio times 1%, okay, and you have a 10% stop loss, okay, meaning that, let's say if a $10 share, you exit at $9, so you will end up, okay, 1,000 divided by 1, you will buy 1,000 units of the share that is priced at $10. So in this case, you are, okay, this one, 1,000 times $10. So meaning that you are using 10K to establish this position. And 10K is 10% of your net liquidation. Okay, so for the second scenario, you also have 100,000. Okay, risk per trade is also 1%. But right now, you have a 6% stop loss, meaning that the stock is $10. Your stop loss is $9.40. Okay, $9.40. So in this case, your risk divided by this one is 60 cents. So how much you will be using to buy? Let me just launch my calculator. 1,000 divided by 0.6. So you will be buying 1,666 units of this share. Okay, if you multiply this at $10, you will be using around 16.6 thousand, okay, dollar to establish this position with a 6% stop loss. This is what it means. So meaning that the tighter your stop loss, you will use up more. Okay, it will use up more of your money, because if you come and think of it, if every stock that you take has a 10% stop loss, meaning that after you buy 5 counters, you still have 50,000 left in your account. Okay, however, if you take 5 position and they all have like 6% stop loss or 8% stop loss or 5% stop loss, you will realize that you might run out of capital. Okay, you might run out of capital. So the tighter your stop loss, the larger your position will be. If you always have tight stop loss around 6%, you will run out of capital after having 5 positions without any leveraging. Okay, without any leveraging. So when there's a big trend and you keep adding, that's the second thing that I want to share with you, this one. Now, when there's a big trend and you keep adding position, you will run out of capital very quickly as well. as the share price goes higher and higher. For example, if you buy MPI, you buy MPI at 15 ringgit and up to 20, you top up again, 24, you top up again. Because the share price right now is 24, 25, 26, 28. Okay, you simply buy 500 units, it might also eat up a lot of your buying power already. Okay, depends on what's your capital. I'm using 100,000 as a base example here. Okay, so with the leverage from CFD, you basically reserve your buying power and you're able to take more position. Okay, because after all, we all know that by taking one extra position, it just increase your whole portfolio risk by 1%. For example, you are in this scenario right now. You always risk, maybe you risk about 6%, and after having 5 positions, you run out of capital. But hey, I can risk more than 5% of my portfolio, but I have no money to buy. So if you have this problem with leverage from CFD, for the 5 positions that you previously have taken, you actually don't need that much. You don't need the exact trade value. Okay, you don't need that much money, meaning that if the position is worth, the position value is like 20,000, you don't need 20,000 cash just to sit aside to take that position. You will require what we call a margin requirement, which is way less than the trade size that you're taking. Okay, so after knowing this risk management thing, you can use leverage. Why? Because after all, taking one extra position just increase your whole portfolio risk by 1%. If it is a good setup, why not? After having 5 positions, I can take the 6th position. I'm risking 6%. I'm okay with it. 100,000 portfolio, I'm okay to risk 6,000. 6,000. Why not? Okay, as long as the setup is good. Okay, so this is how we use leverage. We don't use leverage for the sake of leveraging. Now, some people approach leverage the wrong way. Okay, when they know that what CFD can leverage 5 to 10 times, wow, 笑了. Okay, they put 100,000 and they quickly go and establish a 1 million ringgit or dollar worth of positions. If there's a 10% move against them, they lost 100% of whatever they have. So this is a very risky thing. And so understand portfolio management, risk per trade, all these things. You can go ahead, use leverage at your advantage, and it does not cost you a high level of risk using the leverage. The second thing, you can use leverage from CFD. Okay, in that case, okay, you can add positions on current winning counters, especially if you're taking trading US stock. US stocks, a lot of times, those uptrending shares, they can really go up like 1,000%. Okay, you go and look at in the past Amazon, and you go and look at Tesla. Okay, sometimes when you caught, okay, so we catch one counters like this, if you want to keep adding, very fast you'll run out of your buying power if you use cash to buy. If you know how to use leverage and you have a good strategy, that's how you can use this at your advantage. Okay, so as long as your new average cost is lower than your new trailing stop, you will still make money if the chart turns sour. So this is when we can use leverage at our advantage, and this is how I encourage you guys to use CFD. Personally, I use CFD this way. I don't leverage for the sake of leveraging. Okay, so I have come to an end of my presentation. It's a little bit quick. Okay, so throw me the questions. Okay, throw me the questions in the comment box so that I can address your questions. Okay. Okay, so William, are you there?
Yes, yeah. All right.
Okay.
We will start our Q&A session.
Yeah, I think somebody asked about platform to trade CFD.
Okay.
So of course, we are now talking about Phillip.
Just type in a question box. Okay, so now question: do you and profit on hand? Then you use CFD to increase your position.
Okay, by the way, I think what Jeremy is asking is, do you only use CFD to add new positions? The thing is, if you are using a CFD account to trade CFD, meaning that whatever position you are taking is already CFD. So meaning that you know that you always have the issue of not enough money, despite the fact that you understand that the risk you're exposed to is within what you're okay, and you don't mind to take more risk. Okay, so in that case, okay, you know that you always have this issue, then you can use CFD, okay, as a tool for you to trade. Meaning that for me, because I always have this issue with US stocks, okay, because US stocks, if you trade stocks that are like 1,000 or above, sometimes the stop loss can be very tight, like 3%, 4%. So easily you can take up like 40% of your money, 30 to 40% of your money to just establish one position. Okay, so if you're trading with cash, you will run out of cash very quickly. So understand that if we have this issue always, we use CFD at first place so that we only take around 10 to 20% of our position value, okay, as a margin requirement. So you reserve a lot of buying powers with the cash that you have.
Okay, thank you. Next question. How do you calculate net liquidation?
Okay, net liquidation is very simple. What does the
I'm
word
not
net liquidation means?
exactly.
It means if you liquidate everything in your portfolio right now, how much money you're left with. So how do you calculate net liquidation? You basically add up the total value of your shares. Okay, if you sell, how much you will be getting back. Okay, so that's the total value of your shares. Okay, plus whatever cash you have. Okay, total value of your shares plus whatever cash you have. Okay.
Okay. So, okay, thank you. So the next question here, how often do you add position?
Okay, I think this
Which
one I
means
answered
how
already. How
often do
often?
you increase your position?
Meaning that take new add position. Okay, so how often is the first position adding is usually for me myself, my practice is when I have already achieved 2R. Then I will look into whether or not there is an opportunity to top up. It depends on situation. I don't do a lot of top up as well. Okay, I don't do a lot of top up as well. But in US, I'm more willing to do top up because in Malaysia sometimes we have volume issue. Okay, so the share when it goes higher and higher, the volume becomes thinner, thinner, and thinner. Okay, so in US, this is a very common strategy, and I feel at ease when I top up. So the bare minimum is at least, of course, 2R of risk, 2R of unrealized gain before I will think about adding position. Okay.
This kind of answer the next question. The next question is asked by CLI. He's asking if your risk is 1%, how? Yeah. Hello. Can you
Hello. Yes.
hear me?
Okay. Which one you're asking?
The next question is by CLI. He is asking if your risk is 1%, how about reward? How do you set your reward?
For reward, I don't set a target reward. Basically, I use a strategy called trend following strategy, and there's one tactic called trailing stop. So meaning that if the share keep going higher and higher and higher, I just trail up my stop loss, okay, become a trailing stop. Okay, so I only exit when the trend actually kind of becomes shaky or becomes like there's a sign of beginning of downtrend and things of that nature. I don't really target a reward. Okay.
Questions. So the first one is, can you tell how do you spot the time? What kind of structure is the best structure for you to enter a trade?
I can't hear you clearly just now. I can't hear you clearly just now. Which question you are referring to?
Oh, okay. It's the last second question. The best time to enter a trade?
Best time to end. Okay, the best time to enter the trade, is it? Yes, can, but very robotic.
Yes, correct.
The best time to enter the trade for me is in an uptrend, okay, when there is a pullback, but I don't enter when there is a pullback. I enter when it recovers, okay, from a pullback, meaning that it rebounds and it has the sign of recovering, a trend continuation pattern. For me, that is the best timing in my opinion, okay, to enter a stock with great probability of winning.
Okay. Thank you. Just one last question. Can you hear me now?
Yes.
Actually, this person is asking about a particular stock called the Palantir. So, what do you think of these stocks right now? And what other US stocks is in your watch list?
Can we really talk about this?
or probably, I think you can just share on what kind of stocks in your watch list. Yeah,
Okay,
to let people to have a better idea what kind of stock.
Okay, for me, it depends on what is your strategy, by the way, because if I tell you what are the stocks that I'm watching, you would think that I'm a ridiculous person. I'm a very crazy person, okay? Because my strategy and for the type of stocks that I'm watching, I always pretty much watch stocks that are trading at 52 weeks high or all-time high. Okay, 52 weeks high or all-time high, meaning that they are trading at for most people, is very ridiculous. Okay, but again, this is because the nature of me entering stocks and trade stocks. Okay, so I'll just give you can go to some of the technology stocks. Okay, not only technology are good, okay, but a lot of technology stocks you can find this pattern, meaning that the stocks are trading at all-time high, okay, or slightly below all-time high. The trend is still uptrend. Okay, so these are the types of stocks that I am looking into. Okay.
Okay. Thank you. So just one last add-on question from Jeremy. I think this question I can answer him because he's asking about liquidities. He asked,
Yes.
because you mentioned just now that in Malaysia the liquidities get high, the liquidity start to get higher and higher when the price go up. How about our CFD liquidity? So basically, for Phillip Futures, our liquidity is fully similar to the real stocks market from the stock exchange. The bid and ask price that you are seeing from the US exchange or from the Bursa exchange, the volume, the buyer and sellers queuing are exactly similar in our Phillip Futures CFD. This is also one of the reasons why Phillip Futures CFD is one of a very good product to trade because we fully follow the exchange. There is no different pricing. We don't amend the price by our own. Okay, so we are using a direct market access kind of model. All right.
Yeah.
Okay.
This
I
one.
guess that
This one actually.
all for
Yeah.
our
This one.
Q&A section.
Yeah. To add on a little bit, this one actually can be the information can be found in in the first session of this online event series, whereby we talk about CFD introduction. Okay, there are two types of CFD. One is DMA, one is market maker. So this one, Philip, is DMA. So when it's DMA, okay, it follows the market liquidity. So more information, you can watch the first session, which is actually in my page, in my Facebook page. Okay, you get to know what is DMA and also what is market maker. All right. Okay. Back to
Yes,
you, William.
correct. Thank you. Just to let all of you know, motion on our US share CFD for 3 months, where our brokerage rate US CFD is only 0.3%. For this one, actually, our brokerage right now under the promotion period for 3 months is even cheaper than the stockbroking cash account at other stockbroker. Okay, so if you want to know more how to participate, you can let us know. Okay, it's very rare that a margin account provide this kind of with good margin and also very low brokerage, and you even get a lucky draw to win all these prizes. Next will be account opening. Okay, so for those that wants to open a futures trading account, feel free to just scan the code first, and you can fill up the form online later on. I can just give you 10 seconds to scan the QR code. Okay, we are the first broker house in the market to introduce online account opening. Okay, everything is free of charge. You just need to scan, fill up, and fund in a minimum of 1,000 to activate your account. You can use the money to trade. Okay. Yeah. So just to let all of you know, if you want to join our commodities, okay, our Phillip Capital Singapore analyst, he will be sharing on what kind of commodities that we can expect to move in the first half of 2021. This is a very interesting topic because commodities usually help us to understand better how the entire market runs, where the hot money is going to flow to. Okay, you can scan the QR code again to register for the event. Or if you want to register, you can feel free to pop to our website to register under the seminars and webinars tab. Just to let all of you know that we also have Facebook link. Feel free to like us, and also next month, Bong Jeen Hao and our company, we will do a 10 minutes podcast on our Facebook page. We will share about something very interesting about USCFD and the markets. And we also do it on a weekly basis. Okay, our company a podcast on what is happening next or what kind of products we can look at. Okay, in our YouTube, we also have YouTube channel, Telegram, etc., etc. Okay, feel free to search us at Phillip Futures Sdn Bhd. And this is our contacts. If you want to know more, okay, feel free to contact us. Okay, with that, thank you everyone. I guess that is all for tonight. Okay, and thanks for your time again for joining us. Thank you. Yeah, and good night everyone. Bye bye.